Our next guest has been very critical of the Federal Reserve in the past, saying they simply don't know what they're doing. We've brought him back today on this very important Fed day. Greg Weldon joins me now. Greg, good to see you again.
Sure, my pleasure.
So, Greg, I want to start by bringing up and pulling up a chart you brought to our attention last year. So if we can pull it up a second. And it still very much applies to this day. I'd like to highlight the Fed balance sheet account line, which is in orange, and the S&P 500 index, which we see in purple. And when we spoke last December, you were projecting new highs in U.S. equities in the first half of 2014, and then a steep decline in the fall, which is really what we've seen. Now that everyone expects QE to end today, Greg, do you expect more volatility?
Yeah, I absolutely do. And the reason for that is because amazingly, as you get this little wobble in the stock market, which, percentage-wise wasn't huge. It wasn't something we've seen before when the Fed has ended QE1 or 2. And already on television, you're talking about QE4. And to me, that's a little mind-blowing. I think it's going to be a difficult transition for the Fed to, first of all, they're going to work forward guidance backwards. We've seen that already in the futures markets in terms of the anticipated degree of Fed rate hikes into 2015, 16, and 17. That degree of rate hikes anticipated by the markets has already been shaved dramatically. We think I think the Fed's next move would be to further rein in forward guidance as it relates to future rate hikes, let alone another round of easing of a quantitative nature. I think that's at least 2 steps away. I think if that's what the market is pinning its hopes on right here, it's going to be disappointed. And I think that applies to Europe as well. Thoughts of unsterilized bond buying, sovereign bond buying by the ECB in a big way is several steps away. And I think those hopes could be also met with disappointment.
And we'll get to Europe in a second, Greg. But first, looking more closely at the correlation with QE and equities on your chart, you highlight the 3 occasions where QE ended. In 2 of the 3, the S&P was down 18% within months. Then each time the Fed returned with QE, stock reflation restarted. Greg, now that QE is set to end today, do you expect to see continued downward pressure on equities and in turn, consumer confidence in the U.S.?
Well, I do, and I think that there's a little bit of an interesting twist here than on the past few occasions QE has ended. And I think that the economy has shown some signs of some stabilization. I hesitate to say reflation. I think that's too strong a word. You still have dysfunction in the labor market. You don't have wage growth. Without wage growth, you don't have the ladder of reflation. You can't climb to the top rung that the Fed wants to achieve without wage reflation. So I think that is the key missing link. But you do have some improvement, around the edges of the economy, which will make it more difficult, I think, for the Fed to justify coming back quickly with QE4. It will be seen as being directly related to the markets. And we know this already. We know their primary directive right now is to maintain reflation in the stock market because that has allowed for, reflation in the consumer. It doesn't hurt that gasoline prices have been down. It also, it gives us a little bit of a cushion. But I think things are different this time. And I think it's going to be difficult for the Fed to come back with QE4 so quickly.
Now, Greg, let's say the Fed doesn't plan on raising rates. What do you think is stopping them from doing so?
Well, I think it's the dysfunction in the economy. There's a lot of talk right now about what's happened in Sweden. They cut rates to 0 yesterday, basically, capitulating to the fact that they acted too quickly and too aggressively. And the thought process is that Janet Yellen cannot afford to do the same thing, that we cannot make the same mistake as the Riksbank because the economy is just not healthy enough. It's not reflating. It's barely fixed. It's been stabilized, but it is not functioning. There's dysfunction still in the labor market and to some degree even in housing.
So on that note, Greg, let me ask you, the strength that we're seeing in the US dollar, is it simply a response to the weakened euro? What's at play?
Yeah, I think it's a response to weakening in a lot of currencies where you still have trouble. And this brings up a whole nother tangent thought process as it relates to, the end of QE3 and what about QE4, specifically as it relates to emerging markets. They have been underperformers. They've been under big pressure. You see a number of currencies really beginning to come unglued. Even in Sweden, the krona came under big pressure yesterday. You have problems throughout the world where a reeling in of forward guidance is not going to be enough to stabilize emerging markets. So this brings up a whole nother question. Dollar bullishness to me is purely a sign of increased anxiety around reflation around the world because it is just not happening. And if the Fed is going to exit the party here, the dollar is going to be very strong because all these other currencies are going to be very weak.
So Greg, let's talk gold now. Last time we spoke, from then till now, gold's up about 2%. We've had a few pops in the market since then, but how do you see the overall performance of the metal? Should investors be worried?
Well, there's risk to gold, no doubt. I mean, this 1180 area is so clearly, technically a very important level. You go to the weekly and the monthly charts. We produce these in our daily research. You can see them. I mean, it is such an important level. Maybe it's too obvious because it's so clear. And, if you get below it, you might get you find a sell off and come back. I think gold is probably, on a risk reward basis right now, probably a buy right here, because I think you can play it off the 1180 level. I think you get a breakout through 1260. You might have some upside run. You're starting to see gold rally in some of these other currencies that have been real weak. That seems to be part of the problem, though. How is the dollar going to weaken? And can you get gold to rally in tandem with the dollar? I think there's a chance that could happen. I don't say it's the odds-on probability, but that would be the best case scenario for gold if they maybe even came with another QE or some kind of thought process around, dangling the carrot of QE like the ECB has been doing for so long. Maybe that will finally entice investors to, say, hey, look, they've done QE 1, 2, and 3, and we're still doing now. We still have to do this. Maybe there'll be some movement of capital back into gold as a safety play against either a failure of QE4, QE3, or the success of QE4. I mean, the stock market is going to make new highs. Gold should not be making new lows.
Greg, thanks so much for joining us. We'll see what the Fed says.
That'll be interesting anytime.
And thanks for watching this edition of Kitco News with Greg Weldon. In the meantime, you can email us any comments or questions at newsfeedback@kitco.com. Thanks for watching.